Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Jeffrey Hirsch, editor of the Stock Traders Almanac.
Jeffrey has quite a story to tell about the Stock Traders Almanac and about all the market history that he's researched since he was a kid working with his father. So let's do it. Let's talk with Jeffrey Hirsch. Let's do it right now. All right. Jeffrey Hirsch, welcome to the show, sir. Thanks for being here.
Great to be with you. Thanks for the invite, guys.
Yeah. You do something that is really cool in creating this Stock Traders Almanac. Have you always been all your life just a sort of a data fiend like this? I mean, is this has this always been like the direction for you?
No, but I was kind of born into this. You know, my father started the Almanac back in the 60s. So it was kind of like osmosis or trial by something, by birth or
Right.
association. So, yeah, I worked with him over the years in school, middle school, high school, running numbers, not like, not like a bookie, but we used to do the calculations for the Almanac with the Barron's Lab pages and a little ruler and a red pen and a piece of graph paper and an adding machine.
Wow.
I used to ship out the books. I used to look at charts over Dad's shoulders, but I was trying to, make my own path. And then, back in 1989, my friend said, "Jeff, what are you doing? Go work for your father." So I said, "All right, But luckily, there was a click there. I mean, the man, the legend, had a mind and an iconic way of thinking like nobody else. I mean, that's why the Almanac's been around for as long as I have. It's the same age as me. But when I got in there with him, we had our moments, but there was some things that happened that I kind of saw. I thought like him a little bit. And there was one moment. I forget exactly what the seasonality or analysis was, but there was a group of us around a conference table, some of the other writers or analysts, and Yale was making a point and nobody else got it. And I got what he was saying. So that was kind of where it clicked. But I'm kind of a stickler for details and numbers. I'm a little obsessive about stuff, but kind of genetic.
So that's interesting because I asked you that question. You said no, and then I feel like everything you said after that was yes.
Well, I guess it was because I kind of wanted to, like make your own mark, like every person does, and then you end up. I mean, I get asked now, are my son's going to follow and be the third generation? They might, we have discussions. I'm not pushing it. One of them's, going to be 20, the other one's 17. So we'll see. Let them see the world a little bit before they come back. But we talk about the market and history and things like that. So it's
okay.
It's possible.
But it doesn't sound like they work with you as closely as you described working with your father. Is that accurate?
No, not as much because I think it's more the world's different and there's so much more of it's just. I mean, what we should do by hand is a click of the button or a couple little codes. So, my business partners programmed all the stuff that we used to do on graph paper. And when I ended up converting it to Excel for DOS back in the early 90s and then Windows 3.1. And then it's beyond my math capabilities. My algebra is not as strong. But no, they're not as. I mean, they're there. They've been to events with me. They've stood in exhibit halls and schmoozed and talked about it, but not quite as involved. No.
It's really incredible that this thing is still around.
It's a testament.
Yeah. It's valuable. A lot of people want it, and they want it year after year after year for decades and decades. That's that's our dream in the business that we're in. You want subscribers that just can't get enough of you for decades and decades. So good on you for being able to keep doing it.
Thank you.
I mean, it must have changed. The Almanac must have changed in some way over the years. You described how the process, of course, is now automated, where it was manual in the beginning. But what about the content? Are you doing anything differently? Are you, what's different about it?
Well, I mean, there's less has changed than you'd think. I mean, it's amazing. Back in '69, my father had a page on October. Being this month where bear markets bottom. It's the bear killer.
Hmm.
That hasn't changed. There's a lot of stuff that hasn't changed. It's
Right.
basically changed as much as human behavior has changed.
Right.
Um, there's been some shifts. We have something called the indicator graveyard. The September reverse barometer and a few other things don't
Hmm.
go in there. Some of the best days of the month, the monthly 5-day bulge, but the format, the layout, yeah, there's been some stylistic tweaks here and there, but there's still the weekly diary pages. I mean, the monthly almanacs. Some of the things have shifted a little bit. We've got the mid-month spike that's kind of came in with the payroll deductions coming in every couple of weeks and going right into the IRAs and 401ks, and fund managers having to use it. But a lot's remained the same. You know, we still celebrate all the holidays that we all as a society celebrate. We still pay our bills monthly. We still start the week. I mean, crypto and some of the 24/7 trading, is changing things a little bit. But I mean, if you look at the half hourly trading patterns in the back of the book, was one of the things I was saying that I used to do the calculations with for my father and for the book. That 2:30 Eastern time low, the rally, the close, the sort of intraday trading patterns have stayed the same. So we've updated things. I mean, post-election years have been a lot better
Hmm.
since '85, but look at what's going on right now. I mean, President Trump is coming in and really shaking things up like we haven't seen before, at least in my lifetime, and
Hmm.
it's sort of creating that sort of old school post-election year pattern where the first quarter is kind of weak, quite weak. I mean, we're looking at a potential correction, so a lot stayed the same. It's kind of like Zeppelin. So the market remains the same, human behavior remains the same.
I'm glad you I'm glad you said that. I'm a huge Zeppelin fan. Um, so recently, just last couple of posts on X.com, um, I noticed one of them was on February 26th. Beware the Ides of March, rather turbulent in recent years with wild fluctuations and large gains and losses. March has been taking some mean end of quarter hits. Post-election years open strong, then fade mid-month. Recent years
Yeah.
trend lower. So um, but then you sound a little more bullish a couple days later. March 1st, trading day bullish, DJIA up
I
51x at
mean,
75 years.
that's
So,
just history.
yes,
That's not me sounding bullish. That's just pointing out that trading day has that history, and
I
it
see.
didn't really. We had some news events that I'll use a pun trumped the
They sure did. Trump did the long-term historical
pun
trend there.
intended.
Yeah. Yep. Yeah, there's a lot of trumping of long-term
A lot of
historical
that
trends
lately.
going on right now.
Yeah.
Yeah, I mean things are getting shaken up, but you look at page 28 of the Stock Traders Almanac, and it talks about post-election years performance by party, and back in the 60s and 50s, 60s, and 70s, um, Republicans would come in and really change things quickly. And there's a history of weakness in post-election years under Republican administrations. And when incumbent parties are ousted, like we had last year, the post-election year tends to be weaker.
Mhm.
Um, it's also kind of transformed into sort of a midterm election year, pre-election year, where they're trying to gear things up so that they don't lose as much in the House and Senate as they might normally in a midterm election year. So it's a it's a new world right now with what's going on, but it's also kind of typical post-election year behavior where a new administration's coming in and making changes.
Right. And, as you point out, well, you reminded me that of a very popular observation that the market has tended over the decades to perform better during Democratic administrations than Republican ones. And maybe we're getting a bit of an explanation as to why that might be.
That's some of it. The actual real political alignment for good, market performance is Republican Congresses generally preside over the better market gain. The best combination has been a Democratic president and Republican Congress. We have a page on that in the 25 Almanac.
Mm-hmm.
But the margins are pretty thin right now. The Republican House is battling amongst themselves. It's pretty thin, and the full unified government is not necessarily the greatest thing. All Republicans been better than all Democrat, but this is a different thing right here. We're seeing a real change in policy. I'm not convinced that President Trump isn't a follower of the 4-year cycle, and he's really trying to take care of stuff fast so he can come back in, bottom things out, or at least shake things out quickly. It's also, he's on a short timeline with basically 2 years to get things done until the midterm election. So he's, kind of coming out like he said he was going to. And we're tracking it. It's at an inflection point. Honor your stops, stick to the plan, and don't try to second guess this. I mean, let the market be your guide and be your barometer.
Right.
But speaking of barometers, we had a positive January barometer this year. That's one of the things that Yale invented in '72. That's a good sign. Doesn't mean we're not getting a correction, which we're kind of on the cusp of as we're chatting.
Yeah, interesting. I was actually going to ask you about the January effect. Whether or not it's real. I've got a whole book on the shelf that says it is, but lately I've heard otherwise.
Well, the January effect, first of all, is something different than the January barometer.
Oh, okay. The
January effect is the tendency of small cap stocks to outperform large cap stocks in January. That didn't happen this year. Small caps are having trouble with what's going on in the world and interest rates and clearly tariffs now. We've observed in the Almanac that tendency for small caps to outperform large caps, the January effect, tends to take place in the latter part of the year, in the last 2 weeks of December. That also didn't happen this year. That's a concerning sign, as well. But we see small caps start to turn around late October. The January barometer, which is what Yale invented back in '72, along with the Santa Claus rally, is an indicator based upon the S&P 500 that as January goes for the S&P 500, so goes the year, kind of binary up or down kind of thing. There's been some errors, like nothing's perfect. Nothing works 100% of the time. It's about a 75% accuracy ratio, including all, flat years up or down, plus or minus 5%. Excluding the flat years, it's more like 80%. But then there's our January trifecta, which we didn't hit this year, which is the Santa Claus rally, which is the last 5 days of the year, the first two of the new year. His famous line: "If Santa Claus should fail to call, bears may come to Broad and Wall." Yale was a bit of a songwriter. And then you combine that with the first 5 days, which is an early warning system that's been around for a long time, and then the full month January barometer. And when you hit all three, you get the year up about 90.6% of the time for a 17.7% gain. It's on page 20 of the Stock Traders Almanac. 17.7, 90.6, up 29 of 32 years when you hit all three of those January indicators. So kind of standing on Yale's shoulders, we combined those three into the trifecta. So,
and for our listeners, Yale Hirsch.
Yes.
your father.
Right. Yeah. Pop left us in 21 at the ripe old age of 98.
Oh.
So,
and I do want to ask you about you say it's tracking a post election year right now. What is the moving ahead forecast? I think people would be interested in that, of course. Like, we're coming off 2 straight years also of 20% gains in S&P 500, of course, and that's like .com bubble territory. And so, what's the forecast for the rest of this year?
Yeah. My forecast, my base case scenario, which we give about a 65% probability to, was 8 to 12%, leaning on the more recent post-election year pattern with weakness in Q1, weakness in Q3, which we're seeing. Best case scenario was like 12 to 15. That means everything's got to just click perfectly for the president and what's going on there. And then the worst case scenario, we put this forecast out the Friday before Christmas. Worst case is old school weak Republican president, post-election year performance, just like I mentioned on page 28. Trump administration, Republican Congress implement too many drastic measures, inflation spikes, economy cools, rates higher for longer, and stubborn global turmoil, teetering on bear market recession territory, flat to negative full-year performance with broad losses across most asset classes. That was a 10% probability that we put out on, was it December 20, what was the date of that? December 19th. I'm not convinced that we're going worst case right now. We're still looking at that election gap on a technical basis that we're testing right now. Doesn't mean we can't dip a little bit through there. The market really likes to hit stops and go through them if you put them out there. That's one of the things we don't do with our stock picks and ETFs. We don't put stops in the market for market makers to wipe you out of. We have it's sort of an alert. If the stock or ETF closes below the stop, then the next day we'll exit the position. But yeah, market's looking a little bit jittery right now.
Yeah, a little bit. It's interesting that you got so quickly here, just minutes into this interview, we got to, honor your stops and do your risk controls and do all that stuff that traders really are in the business of doing rather than making predictions. Because it usually takes us a little longer to get there, but we always get there with every trader who knows anything what they're doing. I mean, we always get there. We've talked with market wizards. We've talked with Jack Schwager himself. Mm-hmm. We've talked with dozens and dozens and dozens of people who trade for a living rather than like a long-term fundamental sort of value investor, which is what I am. And every time we talk to those traders, every single one of them winds up where you did, saying, but whatever you do, whatever else you may be doing, honor your stops. And then you described how you put your stops out. You don't put them in the market and so forth, which is another thing that everybody says.
The other side of that is, let your winners ride.
Right. Yep.
Right. Yep.
Yeah. They all do it. They all have, and then we get into, what is the mechanism for this? How do you set stops? How do you determine how long to let a winner ride? And it's funny to me. Well, it's not funny. It's just very telling and very obvious that that's where the discussion ends up, because I think the average kind of investor who's sort of a novice and they want to trade more actively, they tend to think that it's all about the entry, what you're buying and when. But really, the discipline is not there. I mean, it is there to an extent. Everybody has their system for when they want to enter a trade, of course, and it's important. I'm not saying it's not. But when I press all the traders, when I press you all against the wall and say, come on now, what business are you really in? They're in the risk control business. And so the position size and the trailing stops and all the rest of it, stop losses, however you set them, trailing or not.
Little diversification,
right?
Or at least, a certain number of positions that you can manage that don't, reduce your edge, but, don't have you exposed to too few things.
Yep. So Yeah, here we are again, Jeff. We're back. Like it's heartwarming. Like whenever if we ever don't get here, I'm going to go, boy, we're never going to have that guy on again. It's just it's like it's table stakes for traders, isn't it? If you don't understand that you're not in the risk control business, then you're not a trader. You're just not going to get it right.
We like to combine a few different disciplines. We're seasonality is our foundation. We look at fundamentals, both stock and sector, as well as economic and technical analysis. Policy like monetary and government policy, as well as sentiment. I like the investors' intelligence for market sentiment. We use MACD to confirm buys and sells for our seasonal trades. And we look at old school chart analysis for stop losses and exits, consolidations. I mentioned the election gap, as a point for the S&P and NASDAQ and the market in general. And then, one of my father's old school exit strategies is sell half on a double, which is more geared towards the small and more speculative trades. For our sector trades, we have sell targets that we put like 10% above the historical performance. For some of the trades, we have trailing stops that we use the charts with, and we'll give more room to smaller, thinner, smaller caps, thinner traded stocks, more like a 20% type of in that area type of stop. But it's still an art. There's no exact science. I'm looking at VWAP a little bit more these days. We've looked at pivot points. I rely on colleagues and other analysts, traders that I know and trust. I look for other ideas there. I'm not so proud that I can't check on someone else's analysis that I respect and use that for my own trading. And I don't trade like day trade or anything. I pretty much trade what's in our newsletter. I eat as much of my own cooking as I can fit in.
Yeah, and just for our listeners' sake, you mentioned MACD and VWAP, MACD, moving average,
convergence, divergence,
right? How moving averages behave relative to one another, and VWAP, volume weighted average price, over 30 days or so, or usually.
I also look at the anchored VWAP where you pick a point, like say say the election gap, the November 5th close or something, or the low in January, or the whatever. If you pick a date or a time frame or 9 months, you look at a bunch of them. But MACD, moving average convergence divergence, is an interesting thing. It was invented by the late great Jerry Appel and carried on by his son Marvin, who retired as well, who was a friend. I knew Jerry as a kid, but it's in his original research. It's to be used as a confirmation of another reason to buy or sell a security, whether it's fundamental, seasonal, or whatever. A lot of people use it just by itself, and it's really to be used in conjunction with another indicator or another analysis or another ruling reason that you might want to purchase or enter or exit a position.
That brings up an interesting point I was going to ask you about was what's one of your nuggets or indicators that you feel like gets misinterpreted the most?
Probably the Santa Claus rally.
Yeah. Why is that?
They just think it's any year-end rally. A lot of people don't realize that it's just the last 5 trading days of the year and the first 2 of the new year. It's not the December rally. It's not the year-end rally. It's not the rally from Halloween to whatever. It's the last 5 days of the year. Basically, between around Christmas and New Year's, where a lot of the world, a lot of the people on the street and in the business tend to take off, and you have some, prop desk pros, traders in there picking up bargain stocks that are oversold from tax loss selling. And there's usually this little rally of about 1.5% or so in the S&P. And when you don't get that, it means that the traders, the pros that are in there working when everyone's out at Christmas parties and New Year's, they're concerned about the market. Something else is going on. So that's probably the most misinterpreted thing. And I think sell in May and go away. People forget about the other side of that, which I coined the phrase, you got to buy in October to get your portfolio sober. So, it's October is the buy is really more important than the sell in May. And we don't go away. We reposition in May. We tighten up stops. We limit new longs. We get rid of underperformers. It's kind of a spring cleaning type of thing. We do that between sort of our end of the best 6 months sell signal and for Dow and S&P, and the end of the best 8 months for NASDAQ, which goes from November to June. And we use MACD for that, to confirm those entries and exits in and out of the best months.
Right. Okay. Cool. Yeah. I'm glad you brought up the sell in May and go away, because, obviously that one, I mean, who goes away in May, right? Anymore? Like, you don't, like, nobody's, I wish I could, but there's trading to some degree at all. I think people maybe, and you could tell me, but misinterpret that one as like what you just said, there's that.
It doesn't mean you sell on May 1st. It doesn't mean that the market goes down immediately. If you look at our seasonal research now, Yale invented the best 6 months switching strategy in 1986, which is most of the market's gains are November to April, whereas the market kind of goes sideways May to October. I've present on this all the time. There's lots of charts. But basically, the old saying, sell in May and go away, is an old British saw, right? You familiar with the rest of it?
No, I'm not.
Sell in May and go away.
You gotta save me here, yeah.
Come on back on St. Leger's Day. St. Leger's Day is the day of the St. Leger's Stakes thoroughbred horse race, the final leg of the British Triple Crown, which occurs in mid-late September, and basically heralded in the beginning of the London season. I don't know if you ever watched Downton Abbey or any of that stuff, but London was pretty much built on a swamp. And if you've been there in the summer, it kind of gets hot and whatever. And they didn't used to have air conditioning back in the days. So the bankers and merchants and aristocrats would all leave London and go up to the country in May. And they do their fox hunts and their horse races and their parties and all that stuff. And then they would come back after the St. Leger's Stakes race and start again with the business of the London season. It kind of runs similarly to close to the Memorial Day to Labor Day period, where we show market volume, the summer doldrums, as we call them, kind of dries up, and we see the market tend to waffle. We don't all go away in May, but I don't know, kids go to camp, people take vacations. My wife and I are already looking at what we're going to do next summer.
Right.
This summer, are we going to go to a national park? Are we going to the beach again? Are we going to go to Europe? What are we doing to get away? And everyone does it. The Wall Street goes out to the Hamptons, and you have this sort of, vacuum or low volume, which is what creates that period. But it's not down. It kind of goes sideways. Actually, you see the market tend to have this mid-July peak, which we had very, specifically last year. There's something we call Christmas in July, which is the last few days of June through the first 9 trading days of July. We see that sort of after the mid-year shuffling of the Russell and the beginning of July, we see that sort of sell-off from mid-July through mid-September tends to occur there. And you have the worst 2 months of the year, August and September, October turnarounds. And that's what sort of creates that vacuum, that flat to weak period where the market's more vulnerable to downdrafts from May to October, and especially July to October.
When you're assessing all these tendencies, these seasonal tendencies, how far back does this data go? Is it like 100 years, or is it the 1800s or the 1700s? How far back does it go?
That's a great point. Great question. Some of the data we have goes back to 1833. There's other people that have data that goes back a lot further. That I use for the 4-year cycle stuff that comes out of the old Cowles Commission. That's Andrew Jackson's administration. But I do show a chart, and I'll get around to this, where we show that the data that I have goes back to 1901 that I really triple checked for the Dow, and S&P is to 1930. We use the close at 29. Some people have stuff that's older. I think the data is a little bit questionable. But if I show this pattern of the 1 year seasonal pattern from 1901 to 1949, or versus 1950 or 1949 forward, and it's like the reverse. It's like buy in May, because it was a whole different economy driven by farming and agriculture, and you see the market, as all the money's flowing into the economy with the buying of fertilizer and seed and hiring of people and borrowing of money and fuel and all the planting, and then it sort of peaks at harvest time in late September. That flips with the military industrial complex, as Eisenhower told us back in, after World War II, where you see that sort of sell in May, or the sideways pattern in May to October. So we go back to post World War II, 49, 50 for some things, for most things. We'll look a little bit further back, and we're looking at the presidential cycle. And then, when NASDAQ started in 71, and we also like to keep things current. We look at the most recent 21-year period rolling forward, and we use 21 instead of 20 because it's an odd number, and you don't get any 50%, 10 up, 10 down kind of type of thing. And we compare over different time frames. And when we look at the monthly patterns, if you look at, back to 1950, back to 71 or 30 some odd years, and then to 21 years, and you see a consistency of a pattern over those three different time frames, then you're onto something.
I see. So if you go back, if it sounds like maybe 49 or 50 is sort of the modern era, right? That's like the oldest date that has any resemblance to how the economy might behave today and how the market might behave today.
Agreed.
One would think that wasn't enough data points, and yet here it is. Here we are, like to establish like a seasonal trend.
How is 75 years not enough?
Because it's only 75. It's not like 7,500 or 750 even. It's
all right. 750 years ago.
Yeah, that we don't get to do that.
There was no such thing as like indoor plumbing, man.
Exactly. That's my point.
So you got to look at things, from a realistic standpoint. You have to compare to what people are doing. I mean, you had communication was people there. I mean, Inauguration Day used to be March 4th because, John Adams had to take his horse and buggy from Massachusetts down to DC. It took him a couple of weeks to get there. Mm-hmm. You can't have that compared to, a Zoom call.
Right. Tweeting.
No, I get it. I get it. I'm talking strictly statistically speaking.
Strictly statistically speaking, 21 or 20 is about as short as I go. I mean, when people were asking me about crypto and I did a whole seasonality on Bitcoin, I did a whole study on that. Mm-hmm. I was very skeptical for a while. I still am concerned about it, but it's here to stay. But it wasn't until we got 10 years of data that I could really, look at it from a stock traders almanac seasonality standpoint. And, you could argue that it really doesn't have valid data until the CME futures started trading. So one of the periods that I begin looking at Bitcoin seasonality is only from 2018 forward, the first full year after the CME futures started trading, which takes out all that Wild West trading that we had. It was kind of like the Vancouver mining stocks or whatever, you want to, whatever craze you want to compare. So it's all relative time frames and statistically significant levels. You got to work with what you have.
Right. Yep.
And
it works, right? I mean,
it does work. Amazingly.
Amazingly, yeah. Actually, you know what I'm wondering, Jeff, here? I'm wondering about Yale. I'm wondering about your father. Do you know what got him started in this? Do you know why he became interested in this?
I do. The story goes that his cousin, Samson Kozlow, who I named my first son after, was my godfather. He was a songwriter, wrote the song Cocktails for Two and My Old Flame, produced the movie Copacabana with Carmen Miranda. And he was a little bit older than Yale. He sold one of his music publishing companies to RCA or something for stock, and the stock got hammered, and he got, he got serious and began to analyze the markets, and continued to do that. He wrote a book called Super Yields. But back in 1961, my father, was in the war, never really went overseas, was bounced around from school to school, and ended up in the officers' mess, like kind of cleaning up. And there was a piano there, so he was playing that piano, and then came back and went to got a degree in music at Brooklyn College on the GI Bill. So he was, in the music business, working, publishing. He was a songwriter and kind of working with Sam. And then in 61, Sam puts out an ad for a new publication in Barron's, Indicator Digest, out of Palisades Park, New Jersey. He runs an A-B split, with 2 different headlines on the 2 presses in Barron's, and it hits. He calls my father, says, Yale, I want you to run operations for me. Come work for me, in this newsletter business. A few years later, Yale has this epiphany to take all of the market's indicators, patterns, strategies, and put them all together in a calendar format so he could follow the market schedule along with his own. And that was what became the Stock Traders Almanac. So in 1966, in February, when my mother was, several months pregnant with me, I was born in May of 66, he goes out and incorporates the Hirsch organization and begins the 18-month research process using all the Barron's lab pages and all the stuff he had learned and picked up from Indicator Digest, and created the Stock Traders Almanac and put the first edition out, the 1968 edition, out in the fall of 67. And the version you see today is not all that different in shape and content. I mean, things, as I told you earlier, evolved. We've perfected things, we removed things, we've gone through different covers and different bindings and that sort of stuff. But basically, the calendar format of what to expect from the market on any given day of the year is still, much like the original.
That's so cool. It's amazing too. It really is amazing, considering how different trading and everything is now to what it was then. You're still able to present very similar data, and it still has value to traders, even though trading has just completely been revolutionized. It's
just faster.
Very cool. Yeah, it is faster.
Yeah, right. That's
and
the point, right? You don't want it to change.
And,
right? Yeah. You got to learn from the history, right? Like that's the whole point. Yeah.
The old saying from Santayana is that those who fail to remember the past are condemned to repeat it.
Right.
I like to say that those who understand market history are bound to profit from it.
Oh,
cool. Yeah. I love any story that well, that's an awesome quote, but I also love any story that starts with my cousin. That's a good one. And Dan, I got to bring up the obvious for you. Like the musical background here. Dan's a classically trained guitarist. Like there's some.
Are you really? Fantastic.
Yeah. I was.
My father wrote a musical, like a literal Broadway musical. It's called American Melissa, about the Elephant Man.
No kidding.
And he wrote it during the Gulf War I, when Schwarzkopf was doing all those press conferences. And I had moved back home. This is when I started with him. And I was basically living under his piano in my room downstairs, listening to him compose this thing. Mm-hmm. And ended up trying to produce it. Didn't get anywhere, but, we spent a few bucks on it, had a reading. But so you're a classical guitarist?
Yeah. And actually I never wrote a musical, but I did in college. I set music to the lyrics that are included in Bertolt Brecht's play, The Good Woman of Szechuan.
Cool.
So that's the closest I ever got. And I worked in a lot of musicals in college and after, just in orchestras. And I played in a what they call a zarzuela, which is like a light comic Spanish opera on stage at the Kennedy Center. We were playing these little, it was a Spanish thing. It was set in like the 18th century or something with all the costumes. And so we were wearing these like Captain Crunch hats with puffy shirts and beetle boots and capes.
Like the Three Amigos.
Yeah, but we played our instruments on the stage, and the conductor was like, we started backstage when we were playing, so we had to get the cue from the conductor on a camera. It was wild. It was a wild experience. We got to work with Placido Domingo.
Wow.
Yeah, pretty amazing.
Very cool.
Pretty amazing. But that's like practically my whole career, aside from playing solo classical guitar here and there over the past few decades or whatever. Several decades.
My younger son happens to be a fantastic guitar player.
He's
quite a deadhead, but he plays a lot of different things, jazz as well. And my father had an ear where he could hear something and he would play on the piano. Mm-hmm. It's a little bit unorthodox, but my son seems to have picked that up where he plays a lot of different things. And yeah, it's pretty cool.
Yeah, that's how I started. I started sitting there. We mentioned Zeppelin. I would sit there with Zeppelin and just like learn every song and every note on the album, and just I marched through albums. I mean, Zeppelin, Aerosmith, in the beginning, Kiss, and Yes, and all kinds of stuff, just all kinds of stuff. And then I wound up going to school for it.
And I think you'll appreciate this. One of the things I think that made Yale able to see these patterns was his musical composition, that the patterns of music, and not just the music part, but also the lyrics, and that helped to put words together, and also helped him write headlines and ad copy. So the whole songwriting and understanding music and playing it with the pattern recognition. I mean, he taught me a bunch of things here and there. I didn't quite get the talent or the gift that he and my son have, but I think it really lent itself to this whole study of seasonal patterns and historical patterns and cycles, and understanding market behavior.
Yeah, it makes sense.
That's what I was going to say.
I've heard that from other people.
Yeah, that's what I was going to say too. The creativeness, the creativity part of thinking about things, and picking up on patterns. I feel like there's some, I don't know the exact science behind it, but I feel
harmony.
Yeah.
There's a certain harmony to some of these stock market patterns.
Yeah.
Yeah. And if you do read music, well, even if you do or you don't, the pattern recognition is it's essential, because if you look at it as a bunch of individual notes, you will rapidly lose your mind. But that's one of those things where, when I was a kid, people would say, oh, math and music, people are good at math, are good at music, and all this stuff. And I just personally have never, put it this way, I've never felt the connection. We seem to see it in individuals, they do these two things, but I've never felt it myself. I always felt like, well, I'm good at music because I worked my tail off at it for years and years and years, starting as a kid. And, I'm good at what I'm doing now because I've been doing it for almost 30 years. And it's, I don't know what my point is there, but certainly the pattern recognition makes a lot of sense, because you are, I mean, the Almanac, the Stock Traders Almanac that Yale started and that you have continued, is a massive, massive exercise in pattern recognition. That is your game. Right? That is the game you're playing here.
It is. And the real game is matching it to what's going on in the current market.
Of course. Yes. Yeah. That's what I described as the game is step one, right? That's step one. Yeah. That's your research.
Putting it together, and then, compare. Sometimes, you leave the bat on your shoulders because it doesn't line up this time. I know what we're seeing right now is a little bit choppy and volatile, but it does line up with post-election year patterns. So we're still seeing how it's playing out, but it's definitely worth and important to track that right now, and it will give us some vision to what's to come ahead in the stock market this year.
Yeah. And very specifically, since we're talking about the present moment, one trader I know has identified 5,700 on the S&P as a really critical level. And rather than get into what that other trader said, do you care about that level at all?
5,700, it's right near that gap I mentioned, 57.73 or 57.75.
Yeah.
Yeah, that's a big level. Whether that's, how thick you draw that 5,700 line, depends. But that's the vicinity. Just because we break below it, though, doesn't mean the bottom's falling out.
Right.
It depends on what we do after that.
That's an interesting thing, Jeff, because I'm sorry to stop you, but that's an interesting thing, because it's an excellent point. Just because it breaks below, that is the event, but the event requires confirmation, doesn't it?
They all do.
Right.
Confirmation is required. I mean, it's bouncing around there right now. I can't help but look. Forgive me for cheating, but we're dancing with that level. I mean, I had 57.80 as a line on my charts, going through some consolidations. I mean, I try to pick a round number as well. You can pick an exact intraday high or low. But yeah, that's the ballpark. I mean, there's numbers that, like the November, the October-November low. There's the early September low. There's the January low, which we've already danced with. There's that election gap. I mean, it's more than just a number or a level. It's about what happened. That's where the volume weighted average price stuff comes into play. It's you can also just see it if you look at like a candlestick or a high-low close chart. You can see where there's a lot of action around a certain level, but it's not exact.
No, it's not. You know what I think is also interesting about this level is we've basically, at this moment, as we speak, and just a few days before this podcast will be published, we can tell folks that much. We've basically lopped off the Trump election rally, right?
Oh yeah,
we've lopped that clean off. And who knows? Maybe that's it. Maybe that's all we needed to do.
There's another level I look at. Is the mid? Remember I mentioned the mid-July peak earlier when we talked about seasonality and stuff.
Christmas in July. Yeah.
So that's kind of just below that 5,700. The early October lows, the late October, November lows are all around that 5,700 level. So there's a whole bunch of events that happen right around 5,700 that this other trader's talking about, and it's. I've got lines all around that on my technical chart for different support. So, yeah, it's it's game on right now. I mean, it's the test is underway.
Yeah, and I can tell you that you and the listener, the other trader I'm talking about is Hugh Hendry. He's a global macro guy, so he's looking at the market. He's looking at the market in a completely different way.
Yeah,
and yet. You both think 5,700 is kind of important. I find that fascinating when people, and this happens frequently too. We've interviewed, I mean, I took over the podcast in like 2018. We've interviewed, a couple hundred people since then. And we get this a lot. Just as we get traders who all wind up with risk controls of being at the core of their strategies, we also get different people who approach the market completely different ways, winding up with very specific commonalities like this.
We like that.
Yeah.
We like when we get to the same conclusions from different angles.
Yeah.
Exactly. Love that. I love that even from our own editors and analysts who coming from different angles that settle on the same thing and for completely different reasons. I'm like, okay, that's important to me.
Intellectually then, we are intellectually bound then to ask ourselves about the possibility of confirmation bias, because that's what we're looking for, right? We set these. You've created these tools. You've done this research. You go back to 1949, 50, or 1833 or whatever, and then you create these tools. And as you say, the job is applying it to the current environment.
Mm-hmm.
Is the risk control just the mechanism for avoiding the confirmation? Because you don't know that you maybe we're saying.
I think the risk control is a lot of it psychological.
Yeah.
In the words of Daniel Kahneman, losses loom larger than gains.
Yeah.
So, in the perfect world, if you didn't put stops in, you'd probably be better because it ends up getting you whipsawed. But people can't handle that.
Right. Yeah, my point was though, I think I think I'm answering my own question. Suddenly, I'm
Sure.
interviewing myself. It's nice to have you here, Jeff, but I'm going to interview myself.
That's okay.
But I'm just thinking aloud. I just want to think aloud with
Yeah,
you. And what I'm
please.
thinking is to avoid confirmation bias, to be always looking for confirmation, and often seeing it. It seems like the ultimate mechanism for avoiding that intellectual error is the risk controls, the position sizing,
Yeah.
the stops. So
Can I give you? Go ahead. No, yeah. The
No, I'm
stops
done.
help. I mean, for sure, you have to have them.
Yep.
There's another quotation from John Malone. You know, the cable mogul.
Oh yeah.
He was quoting Moses Shapiro from Texas Instruments. He says, always ask the question, if not. Few people have solutions or plans for when their assumptions are wrong. That's Talmudic wisdom. Always ask the question, if not. So if you're what are you going to do if your assumptions are wrong? I may have butchered the quote a little bit. It's in the Almanac, one of the things we put in there. But the point is, always have to ask the question, if not. And we've talked about that a lot. So that's one of the things that I keep in my mind, whether it's risk controls, stops, or whatever it is. You got to ask yourself to avoid the confirmation bias or recency bias, or whatever bias you want to say. You just ask yourself, what happens if I'm wrong?
Right. So you can tell I don't normally think like a trader, so that when I try to do it, I have to do it out loud in a very simplified way. But
I'm with you.
Yeah, I think we've gotten somewhere here. We are actually at the point where we got very quickly today, because it's been a fun talk, of our final question. It's time to ask our final question. And it's the same question for every single guest, no matter what the topic, even if it's a non-financial topic, identical final question. If you've already said the answer, feel free to repeat it. Simple question. It's for our listeners' benefit. If you could just leave our listener with a single thought today, what would you like that to be?
Single thought. Those who understand market history are bound to profit from it. I mean, you have to, take into consideration what's happened before and what's happening now. Patrick Henry said, I know of no way of seeing the future but by drawing a line from the past through the present.
All right. I like that a lot. It's actually very wise, isn't it? It reminds me of the difference between the inside case and the outside case, right? People look at a company and they look at a company in a particular circumstance, and it's a mistake not to consider other similar companies in other similar circumstances previous to that one. That's the outside case. They just, and that is what you have described. History, your study of history, that's the outside case to whatever's happening in the market today. It's very wise, Jeff. Thank you for that. That's a great final thought. Listen, it's been great having you here and talking with you, and I hope we'll do it again. We should pick a good seasonal moment to have you on the show. March is not a bad one, I have to say, of a post-election.
How about the end of April, when the sell in May period comes?
Oh, so the sell in May period. Or maybe we'll wait till St. Ledger's Day and we'll get all of that, history up to then.
Sure.
All right. I'm going to remember St. Ledger's Day now. Maybe we'll try to do that.
Yeah.
All right, Jeff. Thanks a lot, man. It's been great.
All right, gents. Appreciate you. Thanks.
All right.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.